One.
Hello, everyone. Welcome back to Finance Friday on the ARCUK YouTube network. I'm Hard Money Jim, back at it to talk about money creation and its consequences as it relates to Silicon Valley Bank and other near bank failures. Now, I'm speaking to you today from Coronado, California, where the beach is right across the road, and I can walk out about 100 feet from my house, stand on the rocks, watch the waves roll in. Lucky me. But looking at the waves a few weeks ago gave me an idea for an analogy that applies to understanding the role of commercial banks in money creation. Now, that might sound like a stretch, but stay with me for a few minutes and see what I mean. So imagine that you're standing on the beach with a small child and you spot a large sea creature with a large dorsal fin. And the child is frightened and says, "Look, Daddy, a shark." And but you look carefully and you say, "No, son, that's a dolphin. It won't hurt you." But the child has just watched Shark Week for the first time, and this sure looks like a shark to him. In the child's mind, if they look the same, they must be the same. And lacking the knowledge that sharks and dolphins are completely fundamentally different animals, your child could not possibly know that the beach is safe or whether he's swimming in shark-infested waters. And I think a similar kind of ignorance blurs the distinction between commercial banks and other financial institutions. Excuse me. My phone is ringing. Should have turned that off. A similar kind of confusion blurs the distinction between commercial banks and other financial institutions. And that ignorance persists, I believe, because very few people understand how banks actually create money. As I've previously written in another in a Substack article, money creation is kind of a black hole in the universe of economic knowledge, because practically nobody understands it. And the widespread ignorance of money creation has never been more evident to me than during this recent failure of Silicon Valley Bank, because nearly all financial writers portray commercial banks as financial intermediaries rather than as money creators. And they are thus relying on a false model to explain how banks like SVB, Silicon Valley Bank, work. The misunderstanding extends beyond just young children, like in my example, but it includes educated adults, political pundits, financial journalists, and even professional economists. So let's dive into the nature of this error, why it persists, and why it matters to you. To illustrate, this is from a March 13th Bloomberg article explained from a well-known writer explaining the SVB failure this way. The way a bank works is that it borrows short to lend long. Simplistically, a bank might get its money from demand deposits, checking and savings accounts that customers can withdraw at any time. And the bank might pay, say, 0% interest on those deposits, and then it invests the money in some longer-term assets, loans, and bonds that don't get paid back for years and that pay, say, 2%. The bank earns 2% on the money, pays 0% to depositors for the money, and keeps the spread. Now, the author is saying here that banks invest the money that they got from their customer deposits. The bank allegedly borrows, quote, unquote, customer deposits, which it promises can be withdrawn at any time. It can be, given back, withdrawn at any time by the deposit owner at par value, and uses that deposit money to make loans or buy bonds. Those are the longer term assets. Now, I want to stress that this description of banking is not unique to Bloomberg. It's just one of the dozens of articles and commentaries I saw that explain banking in exactly this way. But the problem is that banks decidedly do not work this way. They do not, quote, get their money from deposits. they do not invest their depositors' money, nor do they invest their own cash reserves. And if you're skeptical about that statement, stay with me. To prove the point, we're going to compare the development of two bank balance sheets as they receive deposits and then invest. The first is going to be a bank balance sheet from a non-existent bank that I will call the bank of fiction, or let's call it fake bank. Fake bank operates just as the Bloomberg article describes. And after we look at this, we're going to compare it to a balance sheet of real bank, which operates according to the real banking world. I just want to add anecdote, as an aside, what we're doing here is very basic accounting. It's probably the most neglected skill in the field of economics, in my opinion. You can get a PhD in economics today having never taken a course in accounting, which is, I think, a scandal. Anyway, in fake bank here, we start with a customer deposit of $100. That's there on the right under liabilities. It's recorded as a liability as $100 under customer deposits. And then on the asset side, on the left side, we record the deposit as $100 in cash reserves. So when the Bloomberg article and others say that the bank invests its customer deposits, this is what it means. It means it's investing these cash reserves. Okay, next, suppose fake bank, remember this is a fake bank, invest these cash reserves as follows. They put $40 in long-term bonds and $40 in long-term loans. They lend it out. Now that would leave, according to them, $20 in cash reserves to cover regular withdrawals. And then fake bank's balance sheet would then look like this. You can see assets are 100, liabilities still 100, but 40 have been loaned out in bonds and 40 in loan, or 40 have been used to buy bonds and 40 loans. The total assets and liabilities on the balance sheet stayed the same after fake bank made its investments. And the bank obviously merely swapped cash reserve for loans and bonds, just like any person or corporation might swap cash for shares when you buy stock, or swap cash for a new car when you buy a car. This cash for assets transaction is exactly what the Bloomberg article I just showed you described. But wait, this is fake bank. Real banks do not spend their cash reserves on investments. Let's look at how a real bank, how its balance sheet changes when it makes the same kind of investments. So we're going to start with the same initial condition. This is real bank. Real bank receives $100 in customer deposits and records those deposits on the asset side of as cash reserves. And so far, the balance sheet of real bank and fake bank looks the same. But next, real bank makes the same investment, $40 in loans and $40 in long-term bonds. Take a look. So attentive viewers will notice that cash reserves did not change. They're still 100. That's because banks do not and cannot lend out their reserves, their cash reserves. Notice also that the balance sheet increased on both the asset side and the liability side by the same amount as the total $80 investment. The bank created new money, that is deposits, $40 in the bond sellers' accounts and $40 in the borrowers' accounts. That's on the right. What they did was they created new money in the form of deposits. This ability to create money differentiates commercial banks from all other financial institutions. The Bloomberg article describes how some other financial institutions operate, but not banks. Creating new money in this way is the legal privilege given only to commercial banks, and it's how new money is created in all modern economies. Now, if you're surprised by this assertion that banks create money, as I've described here, I would like to, refer you to my many articles and podcasts on this subject. I wrote about this on my Substack on June 10th, June 26th, and again on August 20th of 2022. I'm sorry, it was June 10th and 26th of 21, and then August 20th of 2022. But don't just take my word for it. Sorry. Here's a few excerpts from the Bank of England's quarterly bulletin, Q1 2014. The reality of how money is created today differs from the description found in some economics textbooks. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. More references are listed at the end of this article, and I recommend them all. Now, I want to make a point here now of how to integrate money creation through lending with money creation through bond buying, bond purchasing. Now, I have said that banks create money by lending and by buying bonds, and it's true, but that sounds a bit arbitrary. I want to go to the next level and give you a more accurate and integrated way of understanding money creation. It's been said that banks, quote, lend money into existence. That's said by some of the people in the few people who are in my theoretical camp of money creation. That phrase, lending money into existence, is on the right track, but it's misleading because it's too narrow a description. In fact, commercial banks are really in the business of acquiring assets. The most common way to acquire an asset is to purchase a promissory note, commonly and perhaps inaccurately called a loan. A promissory note from a borrower is a valuable financial asset that the bank pays for with a promise to pay out money on demand. That promise, commonly and inaccurately called a deposit. So these deposits are then traded and exchanged in the market as money. Bank deposits make up over 90% of what we call money today. So to concretize this, imagine you purchase a car by giving an IOU, a promise to pay, to the seller of the car. Now, the seller would only do this, give you the car based on a promise, if he were very sure that you could pay. In the banking world, the seller of the asset is so sure the bank can and will pay that pay the bank deposit on demand, that promise is treated exactly the same as cash money, for the same value as if it was real cash money. The bank enjoys this legal privilege of creating money in this way. No other financial institution can do this, and this is what makes a bank a bank. Now, if you understand that banks do not really lend money, but instead purchase assets and pay with promises, this goes a long way to understanding modern money creation. Because what is a loan? The Oxford English Dictionary says that a loan is something the use of which is allowed for a time on the understanding that it shall be returned or an equivalent given. Now, the implication is that the lender is temporarily giving up the use of something that was his, as in, I lend you my car for the weekend, if you promise to bring it back with a full tank of gas, or I lend you $1,000 of my own money that already exists, and you pay me back on payday. But this is not what banks do. We say a bank lends you money, but what really happens is you sign a promissory note to pay out a specific amount of money over a specific period of time. That promissory note is a valuable financial asset. It's your promise to pay, very similar to a bond. The bank then purchases that note from you. They pay you not with cash, but with a promise of their own. a promise to pay you cash on demand. And the bank's promise to pay cash on demand is recorded in your bank account as a deposit, even though no one actually deposited real money. The economist Richard Werner calls this a fictitious deposit. The promise to pay, this deposit is then spent and respent in the economy as it transfers to different bank accounts owned by different bank account owners. It is exchanged in commerce just as if it were cash. The same thing happens when a bank buys any other financial asset, such as a bond, and sometimes even stocks. The bond is a promise to pay the owner of the bond a specific amount of money over a specific schedule. That's a valuable financial asset. The bank purchases this bond by creating a deposit, a promise to pay cash on demand, and the bank account of the person or firm who is selling the bond gets that deposit, and then that deposit circulates as money. So banks are in the business of purchasing assets by creating new money in the form of bank deposits. And understanding banks this way allows you to integrate all the money-creating activities of commercial banks worldwide, which is, creating deposits to acquire assets. So all banks worldwide work like this. In every different banking jurisdiction, only banks have the legal privilege of extending credit that functions as money. And as far as I know, any other financial institution that lends money does so by lending their own money or someone else's borrowed money, that is money that already existed and came from someone else, not by creating new money. Those institutions are not banks. They're called financial intermediaries. Now, some people, perhaps the author of the Bloomberg article, would acknowledge that banks are money creators, but they still think the money creation process starts with an initial deposit that gets the money creation process started. That was the theory of Paul Samuelson, who tried to have it both ways by saying that banks are both intermediaries and money creators, and that money creation requires an initial deposit or intermediation. So while there's no time today to go into refuting Samuelson's silly version of fractional reserve banking, but I will just say that Richard Werner unquestionably proves Samuelson wrong, both logically and inductively, by conducting a live experiment with a real bank. The essay cited here in this slide is highly recommended if you have an interest in one of the greatest, economic errors and myths of all times. Also, at the bottom, you can see this video by a man named John Titus, Mommy, Where Does Money Come From? He interprets Werner's experiment just right. I recommend minutes 7 through 20. The rest of it is some vitriol that I probably would not endorse. Okay, so financial intermediaries make loans, also make loans. If you borrow money from an intermediary and you sign a promissory note similar to what you did with a bank, to you, the loan looks the same. But the difference is no money is created. For example, you can get a mortgage loan, and I've done this, from an insurance company, which invests the premiums of its insured clients by lending you some of their money. But financial intermediaries do lend this way. They lend their own money or a customer's money. But a bank loan is different in character. And I've been through the promissory note, and that's how it works. So more references to money creation are listed at the end of this article. I'll show you in a minute at the end of this talk, and I recommend them all, especially those by Richard Werner. This essay that I'm showing here references his other work, all of which is good if you want to get into it. Now, it's worth asking why practically every financial commentator gets the description of banking wrong. Why do so many believe that commercial banks invest the cash reserves that come with customer deposits? There are many reasons, I think, but a leading one is that the myth of banks as intermediaries is plausible because it does explain some of the things we observe. For example, we observe a run on deposits in a commercial bank, and then we observe the same thing that can happen to other financial institutions, and then mistakenly assume that those institutions are essentially the same. You know, like the dolphin and the shark. A run or a similar kind of thing can happen to any financial institution with mismatched assets and liabilities. So you can get a run on deposits, that on an entity that's not a commercial bank. Even a money market fund, which is a financial intermediary that does invest its customers' deposits, can experience a run on the bank in which the depositors don't get all their money back. And the same is true of life insurance companies and pension funds. If the performance of their assets is bad, or if their liabilities come due unexpectedly, their balance sheets can become insolvent. So while it's true that an asset liability mismatch can cause both commercial banks and financial intermediaries to fail, the two are very different entities, just like a dolphin and a shark. Inaccurate descriptions like the Bloomberg article, though, encourage you to think of banks as intermediaries, obscuring their role as money creators. That's the problem as I see it. That's regrettable because understanding how banks create money can help you protect your savings and investments. For instance, understanding money creation will teach you that credit creation in banks has remained the same for hundreds of years. I covered this back in October in a Substack article. Now, even under the gold standard, most circulating money from bank credit most circulating money came from bank credit in paper banknotes or from checking deposits. However, under gold, the quantity and the quality of the new money created were regulated by those who deposited their gold in the banks. It was not regulated by bureaucrats or politicians. So you can read that article and decide for yourself whether our current fiat money system is risky or if you should try to distance yourself from it. Money created by creating bank credit, our enduring system, was widely understood by economists up until the early 20th century, when other theories like the one I mentioned by Paul Samuelson, other erroneous theories followed by the current popular financial intermediary theory gained dominance. And that development, the loss of that knowledge, was a definite regression in the field of economic science. Let me find my slide of. Well, I lost my slide of Jim Grant, but what I wanted to show you was he has a famous saying. Jim Grant says, "Progress is cumulative in science and engineering, but cyclical in finance." I just finished auditing Keith Lockitch's Ayn Rand University course, Foundations of Physical Science, which presented the progress of science from the time when primitive people first looked up into the sky and progressing through thousands of years up to modern physics. And there were long interruptions in scientific progress, but for the most part, scientists have built on the discoveries of earlier scientists, correcting and improving their theories through observation and experimentation and applying strict logic. I wish I could say the same for the science of economics, which sometimes seems to regress, not progress. And Jim Grant echoed that frustration. So while it's so why is it so important to correct this error that confuses financial intermediation with money creation? So all knowledge, I think, has a purpose, has a practical payoff, and this issue is no exception. So, for example, the history of money creation will tell you that until the early 20th century, economists and bankers understood this, how banks used credit creation to increase the money supply. But this knowledge, as I say, was largely lost. But the practical payoff is that just knowing this will put you ahead of most professional financial writers and even economists and allow you to see through their confusing descriptions of money and banking. In a similar way, understanding money creation will allow you to see that central banks work in a similar way to privately owned commercial banks by creating money with a mouse click, except that the central banks can create both new cash reserves, which is final payment money or standard money, and new bank deposits, which is credit money or fiduciary media, when they purchase financial assets from private investors. Knowing this, you can understand how central bank programs like quantitative easing can directly impact the value of your investments. And most important, I think, if you understand money creation, you can know that there's both good money creation and bad money creation. Good money springs from sound investment decisions by banks to fund productive enterprises that will eventually generate real economic growth. Good money creation is both non-inflationary and it promotes economic progress. On the other hand, bad money creation stems from unsound investment decisions. And these bad decisions are most often caused by poor regulation, political pressure, cronyism, and the influence of collectivist ideologies. Bad money creation finances unproductive products, asset bubbles, consumer price inflation, wasted capital, wasted time, misallocated purchasing power, and unjust wealth distribution. For a leading example of bad money creation, just look at the Fed's 13-year experiment in quantitative easing. Knowing the difference between good and bad money creation allows you to take appropriate action when, as today, bad money creation seems to dominate public policy. But if your view of banks is that they're merely investors of depositors' money and not the creators of money, then you're unable to know anything about money creation, much less good and bad money creation or inflation or what to do about it. So that is my pitch for why we all need to understand how money comes into existence. Although accurate knowledge of money creation is surprisingly uncommon, as we've seen in the way people write about it, it's really not hard for any person to acquire this knowledge. So just take the time to learn about it. Its consequences are far-reaching and ultimately will affect you personally. And in my writing in Substack material, I'm trying to make it clear, and I hope you'll give me feedback on whether I'm doing that or not. Okay, let's pause here for questions, comments, and so forth. Let's see. Today's environment. Okay, Bonnie says, I'm finally beginning to get this almost. It's good to know rational sources are out there. Thank you so much. Well, Bonnie, I appreciate that. Don't hesitate to write your questions into any of my Substack columns. I would love to get back to you on that if there's something I can make more clear. Seems tied to Keynesianism. Christopher says he didn't know about this. It seems tied to Keynesianism and modern monetary theory. It is. It's a little too much to go into MMT today, although it's not fundamentally complex. I will just say about regarding Keynesianism. Yes, Keynes switched during his life, began by understanding this issue, but ended up by obscuring it. And it's a question of whether he deliberately, in my mind, whether he deliberately obscured and hid his knowledge of this. Because if you obscure your knowledge of this, if you don't transmit, if you don't tell people this, if they don't know where money's coming from, they don't know how government can abuse money creation. And of course, Keynes loves to create money to spend on, fiscal programs. That is probably the nexus between Keynes and correct understanding of monetary theory. Okay, reserves regulated. Now, Christopher also says there's a big difference between how money comes into existence in today's environment versus the most ideal banking environment, which I guess isn't this. The mechanics of how most money comes into existence are exactly the same today as they were 100 or 200 years ago. Please look at my Substack called Money Creation Then and Now for a ground-up, very simple explanation of how that happens. And I would say the same to Equal to Reality, who says, I think I will need to rewatch this as I don't quite get it. Maybe when I'm less tired, he says, well, if you haven't seen that fundamental article, Money Creation Then and Now, I urge you to look for it, because it's going to use even simpler accounting illustrations than I use today to show you how the money is created. Okay, now let's see how we're doing for time. Oh, good. It's 11:30, so we've still got a little time. Wanted to make sure I've got all the questions here. Well, Tom, you're really nice. This video is worth its weight in gold. That's terrific. I think you're wrong, because gold is really worth a lot. But thank you. And Jonathan, thank you for your contribution. And let's see. Okay, someone says, explain the discrepancy between the 80 miracle dollars. Discrepancy between that and what? Christopher says, oh yeah, they're talking to each other. Okay, I'll get off the chat here. Sometimes it's a little hard for me to interpret that. Let's now, if we can, consider what happened at Silicon Valley Bank. And because it's a specific bank failure, but I think it helps us understand the kinds of problems that we maybe are going to have in the future. So we've had 3 significant bank failures: Silicon Valley Bank, Signature Bank, and Credit Suisse. Who knows? Deutsche Bank may be next, but so far this crisis, if you will, seems to be abating or at least semi-contained. Back on Sunday, March 12th, I wrote a brief Substack piece on Silicon Valley, SVB, and I said its failure was more an indicator of a bigger systemic economic problem than of a banking crisis per se. Although, one doesn't, they both can happen. One does not exclude the other. But then I also wrote that the depositors were going to be made whole by what I call the troika of the Fed, the Treasury, and the FDIC. And as it turns out, that is what happened. The bailout of uninsured depositors was announced Sunday afternoon, just a few hours after my post. And the main reason I felt fairly confident that the monetary authorities would save depositors is simply that this is what the market expected. Government bank bailouts have been standard for many decades. And if you really wanted to start a massive panic and a massive bank run and put hundreds of banks out of business, I mean, just announce that the uninsured depositors are going to take a haircut. They're going to take a loss on their deposits. That would have caused pandemonium. And the Fed, Treasury, FDIC troika obviously knows this better than I do. So they acted to save depositors. I mean, they felt they had to do it. Now, the SVB bank run was similar in many ways to most bank runs in history, but it also had some kind of unusual characteristics. Most bank runs start when depositors realize that the bank's assets are going bust, and there won't be enough money to cover deposits if the assets have to be sold. And, these are sometimes referred to as toxic assets. And we heard a lot about toxic assets during the great financial crisis in 2008 and 9. SVB did have some asset valuation problems caused by rising interest rates, but they didn't have borrowers or bonds that stopped paying interest. They had what I call a toxic deposit problem. And that's why this bank run was a little different. And let me explain that. Most of SVB's depositors were wealthy Silicon Valley entrepreneurs and well-compensated employees of tech companies. Their deposits were related to tech startup businesses, which in turn depended on lots of easy money, low interest rates, and readily available credit. So money invested in these tech startups, money gotten from tech deals, revenue from tech startup businesses and so forth. These were the sources of SVB, of a lot of the SVB's deposits. But then a year ago, the Fed started raising interest rates. The cheap money started to disappear. And when credit dries up and the second and third round capital raise doesn't work for these new companies, or if the depositor gets a margin call because margin lending rates went up and his stock price went down, the depositors might have to withdraw some money. So in 2022, the Fed started raising interest rates and slowly shrinking its balance sheet, making money tighter. Money became tighter, harder to borrow, more expensive to borrow. And when the money stops flowing, companies invest less, valuations shrink, collateral values on bonds and loans go down, and the risk that loans will not be repaid increases. So even before the bank run at SVB started, there were already some concerns on the asset side of SVB's balance sheet. But on the liability side, SVB's deposits were especially problematic. Over 90% of their deposits were not insured, and all the depositors, of course, were well aware of that. In addition, as interest rates rose in 2022, alternative rates like T-bills and money market rates went up, but SVB was still paying their depositors under 1%. So that's even more incentive to pull your deposit out. And next, in true tech fashion, the depositors started talking to each other on Twitter, and the deposit flight accelerated. Now, this is what traditional bank runs look like right here. The one on the left is from the 1930s. The one on the right is from 2007, when the UK bank Northern Rock went under. They're pretty much the same. The image is of people sort of lining up to get their money and hopefully not physically injuring each other in the process. It might take a day or two to get your money, or even after you discovered the bank was in trouble, if you knew, and that itself might take weeks, okay? But it is very different now. Here's what a modern bank run looks like. What is different about this bank run, different from any we have ever seen before, is the jaw-dropping speed with which deposits left the bank. And this is because mobile banking on your phone, is now widespread, and it works really well. So essentially, what happened is that SVB could not sell assets as fast as clients demanded that their money be moved. When you take your money out, the receiving bank will not clear the check until they know they're getting Fed funds from the losing bank. And SVB could not guarantee that unless they could sell assets or borrow from the Fed or the Federal Home Loan Bank. But they couldn't sell assets fast enough or borrow fast enough to meet withdrawals. That's how quick it happened. So only 15 years. I mean, look, $42 billion in a day. I didn't believe this when I saw it. So only 15 years after the traditional bank run on Northern Rock, there are no more crowds demanding cash. There's just people making keystrokes during their lunch break. 42 billion is stunning. So banks, I think this may signal a change in bank depositors, certainly in a big segment. Banks traditionally have benefited from a loyal retail deposit base. We used to call it the sticky deposit phenomenon. The joke was that people got divorced from their spouse but never changed their bank because it was too hard to do. But I think electronic banking maybe has changed that permanently. Could be. So just to be clear on how this works, let's do this again. We're going to take another look at real bank to see how the progression could work in pattern, just in pattern. So start at step one with the spreading knowledge that asset values have declined because of rising interest rates. So there you see that bonds, circled in red, have gone from 40 to 20 because interest rates went up. Remember, interest rates go up, bond values go down. But still, at this point, even though it's true the market value of assets does not fully cover liabilities. See, assets are 160, liabilities are 180. They're underwater. But even at this point, there's still plenty of cash reserves. Cash reserves are 100 and that's a lot. And that should be still plenty enough to cover normal routine withdrawals. And if those withdrawals are orderly, the bank has plenty of time normally to borrow cash at the Fed discount window or borrow reserves from other banks. And so it could, meet those redemptions under normal circumstances using the Fed as a lender of last resort. Now let's go to step two. And in this step, many depositors who are hoarding cash have also decided to move their money to get a better interest rate. Because what we've seen over the last year is that while short-term rates were 0 or maybe below 2%, that didn't matter much to depositors. They were happy to get their low rate. But gradually, as the alternatives to bank deposits started to pay above 2% or so, we started to see a growing flight from deposits to treasuries and to money market funds. Now, this was going on in the background even before SVB had its big emergency problem. So step two here shows the bank in a position of much reduced cash reserves. It's much closer to insolvency. Please note, this is very important. When deposits leave the bank, cash reserves also leave the bank dollar for dollar. We're going to come back to that in a moment. But when bank customers see this happening, that's when the withdrawals accelerate and the run becomes a self-fulfilling prophecy. So this is a great chart from Bianco Research based on data from the Federal Reserve's H8 weekly report, which I look at occasionally. The blue line on the top is all large U.S. bank deposits, and the red line is small bank deposits. Notice that large bank deposits are declining slowly through 2022, but small bank deposits are rising until they fall off abruptly. This slow decline in the big bank deposits is likely due to a gradual flight to treasuries and money market funds as interest rates are rising and they're going for a better yield. Losing deposits was fine with the big banks, and I'm talking about the big four like JP Morgan and Wells Fargo and Bank of America and Chase and so forth. Losing deposits slowly was fine with those big banks, though, because they were very rich in cash. They are very rich, still are, in cash reserves. They don't need these deposits. The rise in small bank deposits was likely due to, that's in orange, was likely due to an increase in small bank lending, which was holding up well despite the rising rates. You look at the Fed's H8, you see lending continuing to go up even as rates went up. Remember, lending creates new deposits, so the deposits are going up. And then about the time of the SVB failure, that pattern reverses abruptly. Look at the sudden drop-off of deposits in the small banks. Small bank depositors are now taking their money either to the large banks, note the little upward blip on the blue line at the very end there, who are better reserved. better able to handle big withdrawals, or small bank deposits are going to treasuries and money market funds. And I think we should expect deposit flight from the small and regional banks to continue, because so far these small banks have not responded by raising interest rates. Let's see if I have a slide on that. Yeah. There we go. This chart shows on the far right that banks are still paying interest rates of about 0.5%, while money market funds have shot up to almost 4.5%. Now, that's a big difference if you have a large amount of cash you want to hoard, because if you have $1 million on a T-bill, you get $45,000 a year versus the bank of $5,000 a year in interest. That's real money. So as rates rose over 2022, we saw deposits leave banks in the case of SVB, which paid very low interest on deposits. And you could say that failure, I'm guessing, I'm hypothesizing that the failure to raise deposit rates was a straw that broke the camel's back as far as many of these depositors were concerned. And although the immediate banking panic now seems to be averted, you should expect depositors to continue to migrate out of banks if they're going to demand, because they're going to demand higher interest on their money, and that's going to if banks raise their rates, they're in a dilemma, because if they raise their deposit rates, that increases their cost and that impacts their profitability. All right, so and just by the way, I suspect that was operative in the case of Silicon Valley Bank. The executives there were very highly compensated based on stock price. High stock price depends on high profitability. High profitability depends on low cost of deposits. I think they thought their deposits were sticky, but they weren't. They should have raised rates to try to keep people there, and they might have avoided this problem. But their stock options wouldn't have worked out so well. All right. Now, when people pull their money from banks, where does that money go if it leaves the banking system? I mean, sometimes, as I say, it just goes from one bank to another bank, like in this case, from a smaller bank to a bigger bank. But money can also leave the banking system. And basically, anytime you send money to the government, say if you pay taxes, or if you buy T-bills or bonds or notes at an auction, or if you buy a money market fund or an ETF that itself invests directly with the government, maybe through Fed repos or so forth. Anytime you do that, your money leaves the banking system. And this Treasury Direct screenshot here is just one example of how you can do that. And maybe you want to if you're not getting a good rate on your bank. You can go to this website, open an account. It probably take you less than a half an hour. I don't use it, but you can use probably less than a half an hour. Send the money directly from your bank to the Treasury and make much better interest than your bank is going to pay you. So, and now this deposit flight is affecting the small and regional banks the most, the small banks. But you may ask, why does that matter? Why do these banks need these deposits? And I've said that banks don't need deposits or reserves to lend, and that is true. Why do they need deposits? And I'm going to reiterate that the answer is when deposits leave the bank, cash reserves leave the bank, and banks need enough reserves to handle deposit withdrawals. When deposits migrate out of the bank, cash reserves move dollar for dollar with the deposit. And I'm sorry if I went too fast on that, but the bottom line is banks need to keep a prudent level of deposits so they have the reserves to meet potential deposit withdrawals. Now, because of the panic around SVB and Signature Bank, you can expect these regional banks are going to take steps to keep more deposits. And that probably means they'll start paying more interest on deposits. That's going to raise their costs, lower their profitability. I suspect lower profitability is something SVB did not want to contemplate, as I just mentioned. But here's the important thing from the broad economic point of view. The threat of losing deposits also means that banks have to be more careful when they're lending, because every time they make a loan, they add deposits. But if those new deposits then leave the bank, then they lose more reserves, reducing their ability to handle a bank run. So it's not that when deposits leave, the banks have less deposits to lend. That's not how it works. It's that the banks lose reserves, which they need to meet a potential run or potential redemptions. So as the bank's cash reserve as a percentage of their balance sheet declines, they become more vulnerable to a bank run. Now, this chart here from Zero Hedge illustrates the cash reserve problems at small banks. And they are developing a reserve problem that looks like. You can see their reserves are, as a percentage of assets, are back down to pre-pandemic levels. That's from the big drain in reserves and deposits they've experienced. So the small and regional bank reserves, or their reaction, is going to cause them to tighten lending, raise interest rates, and slow down money creation. In addition, federal regulators always react to bank panics with more regulations, and that, of course, will further slow and restrict lending. And if this happens, as seems likely to me, it is a very big deal in the economy, because these regional banks are key lenders. They are key money creators in our economic system. Regional and community banks are the backbone, really, of the productive lending in the economy. Regionals alone control $6.8 trillion in assets, more than JP Morgan and Bank of America combined. They do 80% of the commercial real estate lending, 50% of the personal lending, and 40% of commercial and industrial lending. They know their clients, they know their local markets, and they know the risks better than anyone else. So in other words, when we talk about good money creation and bad money creation, the smaller banks are doing more than their share of the good, productive, non-inflationary money creation that fuels real growth. But going forward, if these regional and community banks become afraid of deposit flight, they're likely to pull back on their lending, which will restrict economic growth. So there's a lot more I could say, but I'm going to leave it there. To me, the real systemic risk in this bank panic is that all banks, particularly the regional and community banks, are going to start to restrict their productive lending, which is productive money creation. And then this is going to result in declining economic growth. And then when that happens, if that happens, we can expect the Fed to step in with more QE type activity that will not be productive money creation, but will instead create money for unproductive purposes. So eventually, if they pull back too much and it causes a bad recession, rather than ride it out, we're probably going to get from the Fed more money with less real production to accompany it, which means a continuation of rising prices. All right. So to wrap it up and put the banking panic in broader perspective, I view the SVB incident as one more signal of the stress in the worldwide financial system. We've seen other signals like the blow up in the UK pension funds last September, spike in interest rates accompanying Fed's short-term rate hikes, persistent price inflation, and the occasional liquidity problems that seem to crop up in the treasury market. But I regard this little panic as one more incident in a worldwide economy that's reacting to central bank tightening. It's impossible, for me at least, to predict where the next problem is going to show up. Maybe it'll be in car loans, maybe office real estate. Who knows? We'll see. But I do think there's going to be more. I'm quite sure there's going to be more problems and blowups as this tightening continues. Okay, we better draw a line there. Next time, I think perhaps I should do an inflation update, including what might be the path for consumer prices, both long-term and short-term. So let's look forward to doing that in a few weeks. All right, let me look here at what we got. Christopher says his money is held at a fake bank. That's hilarious. I doubt it. Let's see where I am here. Duncan Curry, 1999. Thank you, Duncan. I appreciate it. This today's podcast was an expanded version of a essay I did called "Fake Banks and Real Banks" just a couple of weeks ago, or 1 week ago, I guess. And it's more condensed, and it's written more precisely. So rather than get lost in my words, you might start with that because you might find it a little easier to follow if you had any problems following me today. Okay. Again, thank you for all your attention, and thank you for your contributions. Daniel, do we have anything else before I sign off and get you off to your next program?
We'll have a TV talk in 2 hours, and that's it. Okay.
Thanks, everybody. Until next time, take care, and sweat your cash. Move it if you need. Move it to a safer place if you need to, and you'll probably get a better rate. Okay. Bye-bye. See you next time.
Okay. Sorry, just to cut you off. Did you answer the super chat question?
Oh, what was that? Which one did I not answer?
From Duncan.
Duncan. God, so many of these. You guys are active.
The question is, how does someone become a commercial banker? How do they get that privilege?
Gosh, Duncan, I apologize. All I did was see your contribution. Okay. All right. So last year, if I remember, there were several hundred new banks started. You can start a bank. My understanding is it takes about a year. You have to register with the Office of the Comptroller of Currency and jump through some hoops. There will be some minimum capital requirements. I don't know what they are. I don't know if they're 1 million or 10 million, but they're not, huge. And it could be you need to do this to get a banking license with the government, but it is possible. Now, at this time, we have more banks on average going out of business than coming into existence. There are still in this country, I think, about 4,000 or 5,000 commercial banks. We're one of the most heavily banked, in that sense, countries in the nation. But I have not gone to the details of looking into it. But if you want a license to create money, become a banker, you'll need some capital behind you, but it can be done. I hope that answers. How do you get that privilege? Yes, you have to get a license and jump through some hoops, but it's done every day. All right. Sorry I missed that question, but now I think it's answered. All right, guys. Thank you, and see you next time, and be careful out there.